What are valuation multiples, and why would one business command a much higher one than another? Valuation multiples are an easy way to quote the pricing of a business. In general, valuation multiples are based upon EBITDA. So for example, if you have a $5 million business and you sell for $50 million, that's a 10 times EBITDA multiple. So what are the factors that determine why you would have a high or a low multiple? Well, there's three. The first is growth. The higher the growth rate, the higher the multiple that can be paid for a business. This is because with high growth, you can essentially grow into a higher valuation and still get the same investment returns for the buyer. The second factor is around risk. Uncertainty is a negative factor that hurts the valuation of a business. If there was no uncertainty, the valuation of a business would probably approach a treasury. But the reality is that businesses have a range of uncertainties, ranging from their management team, whether the transition is going to occur, or just competing out there. So businesses of which have less risk are generally going to have a much higher multiple. One of the factors that really minimizes this risk is the quality of revenue. The reality is most people think of revenue and earnings as the same, but it's not the case. The reality is that all earnings is not created equally, at least in the eyes of a buyer. Think about it like a spectrum. On one side, the most valuable essentially are things of which there's contractual obligations to have payments on an ongoing basis. On the other end of the spectrum, it's basically project-based work. And over time, if for whatever reason there's a downturn, that business may or may not come. And there's various permutations in between. One of the ways that business owners can dramatically improve the value of their business is shifting their revenues from more project-based to more recurring types of revenue. For example, car washes in the past used to trade at relatively low multiples. Then we had some creative business people that decided to sell subscriptions to many of these tunnel washes, and valuation multiples went through the roof. Some have even approached 20 times EBITDA. This allowed lenders to be much more comfortable to lend against these type of businesses, which allowed investors to be much more aggressive with their pricing. The third factor is what I call supply and demand. As we learned in economics, the more supply you have, the lower the price, and the more demand you have, the higher the price. So, if there are a lot of similar businesses like yours in the market at the same time, in general, it's going to be harder to command premium pricing. Similarly, if there is a large universe of potential buyers, there's a much higher likelihood that you'll get a higher price. This often manifests itself with regards to size. Larger businesses typically have the ability to be what's called a platform investment, meaning private equity firms can use it as the acquirer to go and gobble up smaller competitors like Pac-Man. This allows a universe of virtually any private equity firm to be an acquirer. On the other hand, if the business is subscale, it basically means that there is a very limited universe of buyers that happen to be in the same industry and geography that can acquire that business. And like we say, in supply and demand, if you have 100 potential buyers versus 3 or 4, you're much more likely to get a higher price.